In terms of sort of more up-to-date data, we're sort of increasingly using sort of more timely statistics in our work, simply because the situation is evolving so quickly. One of these statistics is the mobility trends that we get from Apple and Google. This one here shows the data from Apple, and effectively sort of maps sort of or takes a note of the of when you ask for directions. So if you're sort of going in your car, if you're walking, if you're going by public transport. All of those sort of searches that you perform on your Apple device will eventually go into the sort of statistics that they're producing here. And what we've seen is that, particularly since we had the renewed restrictions in the middle of September, so the 10 p.m. curfew for the hospitality sector and the introduction of greater restrictions on some areas of the country, the degree of mobility has really started to fall back quite significantly. That's particularly, I think, in terms of things like transit, obviously people being encouraged to work from home again. And I suppose that we would say is probably a sort of good sign that things are starting to tail off in terms of economic activity and the pace of the recovery. The only rider being that obviously if more people are working from home again, that's not necessarily a net negative for the economy, because obviously for what you may have spent going out for lunch where you work, you now may spend going out for lunch where you live. But talking about lunch, another sort of indicator that suggests that things are tailing off is the number of restaurant reservations that we're making. And this chart here doesn't just sort of cater for reservations made ahead of time, but also tries to sort of cater for walk-in numbers as well. And again, has been one of these sort of bellwether statistics that we've been monitoring because it's available on a daily basis. And what we've seen there as well is that the Eat Out to Help Out scheme was very successful in terms of getting people into restaurants in August. But since then, things have tailed off quite dramatically. And again, I think there's been a particular tailing off in numbers of people eating at restaurants since that curfew was introduced. And also, I think since the number of COVID cases increased from the middle of September. Because one message that we took from right at the start of this sort of period, at the start of March, is that we don't necessarily have to wait for lockdown itself to be enforced. The people themselves tend to take steps themselves and try and of social contact when they see the pandemic starting to flare up again. So as I say, I think we're in a situation now where certainly the strongest part of the recovery is behind us, and I think there are signs that things are starting to regress in some areas, particularly these sort of high contact social consumption areas. In terms of sort of forecasting where we go from here, obviously, the first thing to say is that we're not epidemiologists, and that is a big challenge for us because the epidemiology really is something that governs everything about where we go, particularly for the next 6 to 12 months. So what we're sort of advocating as economic forecasters is looking at things on a scenario basis. So though I'm going to give you our idea of what we think in terms of our baseline forecast, so the most likely outcome, I also want to talk a little bit about how we think some of the alternative scenarios might play out if the pandemic doesn't progress in the way that we expect it to in our baseline. So in terms of the baseline, we're effectively sort of assuming that things continue along the sort of lines they've been going over the last sort of few weeks. So rather than our forecast maybe sort of 2 to 3 months ago when COVID numbers were quite low, back then we thought we might have a gradual easing of sort of social distancing restrictions. Now we think we're going to remain with the current level of social distancing in place certainly throughout the winter. So that means things like the 10 p.m. curfew. It means restrictions on people meeting inside. And also, I think it means a sort of series of rolling tier 3 lockdowns. So these most serious lockdowns where we close parts of the hospitality sector and things like gyms. We think that will continue through the winter on a rolling basis in a number of areas. So it might be Liverpool and maybe Manchester this week. Next month, that may have changed. It may be London, maybe Liverpool and Manchester may have come out. But we think we're going to have this sort of series of localized restrictions being put in place rather than the sort of national lockdown that we saw back in March to May. Also, crucially, we think these local restrictions will be slightly less restrictive than they were in that first lockdown as well. I think in particular, I think that what we're seeing at the moment is that the government is determined to try and keep business open as much as possible and also try and keep the education sector open as much as possible. So we think that even in some of these tier 3 lockdown areas, that we will see less stringent restrictions than we saw before. Now, in terms of what that means for sort of economic growth going forwards, our current baseline forecast is shown by the red line there. So it means effectively that the current recovery sort of grinds to a halt somewhat over the next 6 months. We get very little growth compared to what we've had in the last three or 4 months or so. But then as we move into the sort of the spring of next year and beyond, we think we'll see then some relaxation of social distancing. And then as we move into the second half of next year, we're more optimistic that you might get things like a vaccine coming through. And at that stage, you might then sort of start to return to business as usual again. You might see a relaxation of social distancing restrictions and therefore a much stronger recovery. So we have essentially this sort of pause for 6 months, followed then by a reasonably strong recovery that gets you certainly back to something more approaching normality. I mentioned that it's very important to think about things on a scenario basis, and I think in terms of scenarios, we find it much easier to find downside scenarios than we do upside scenarios in this on this sort of basis. In the short term, quite clearly, the biggest risk is that we have a renewed lockdown at a national level, and that the severity of restrictions becomes much greater than it is now. Certainly, I think that would cater for, if we go to the right of the forecast line on that chart, that would cater for the sort of the grey areas towards the bottom of that chart. I think further out, the scenarios then become much more dependent on what happens around things like a vaccine. The sort of the areas above the red line there on that chart that are shaded in grey would show you scenarios where we have a much sort of earlier introduction of a vaccine, which is very effective and gets us those social distancing restrictions reduced much quicker. On the other side, the more negative scenarios under those sort of charts would be scenarios where the vaccine either doesn't come through at all or doesn't come through until, say, 2022 or so. And under those sort of scenarios, you'd have much more restrictive social distancing in place for quite some time, which would really sort of prevent these sectors like hospitality getting back to more sort of normal levels of output for quite a long period of time. Something we're also monitoring on the downside is the potential for this to spiral into a financial crisis. Obviously, the sort of the big challenge we have at the moment is around the banking sector and the fact that they're obviously having to deal with quite a few clients on both the personal and the corporate side who are really struggling to keep their heads above water. I think that the possibility of particularly if we have one of these downside scenarios for the pandemic, could then spiral things into a financial crisis. So I think certainly if we're looking at the sort of the period out towards the back end of 21 and into 2022, then the sort of the areas towards the bottom half of that grey swathe then would be under that sort of scenario where we have a sort of financial crisis where credit conditions tighten and stop us getting back to sort of pre-pandemic levels. But I suppose the overall sort of message from that chart is probably what's shown by the end of the sort of the right hand side of the chart there, and that sort of the degree to which dispersion between the top scenario and the bottom scenario. If I were to put this sort of chart up in more normal times, you might have a range of maybe 3 to 5% between the sort of the top and the bottom of what we might call the plausible scenarios. Under these sort of circumstances, that swathe is as wide as 14%. And that really does, I think, give a demonstration of quite how uncertain things are. And so most of that uncertainty comes back to the path of the pandemic and also the government reaction to it. One other source of uncertainty we have is around the labour market. And that really sort of comes from the interventions that the government have made so far. And again, what the government will plan to do sort of from this point onwards. Obviously, the big challenge that we have at the moment around the labour market is that the coronavirus job retention scheme is due to end at the end of this month, so in another 10 days or so. And at the moment, according to the latest statistics we have, which are for the middle of September, about 9%, which is about 2.5 people, were still on furlough. So there is quite an impending crunch coming up as companies decide what to do with those 2.5 million people. Now, are they going to keep them in one of the successor schemes to the job retention scheme, or are they going to make them redundant? And are we going to have quite a sharp rise in unemployment? Now, what we have in terms of sort of the successor schemes to the job retention scheme is, in particular, one called the job support scheme, which has two aspects to it. In areas where firms are forced to close, so for instance, in the moment in Liverpool, if you're in the hospitality sector, those employees can be furloughed on 67% of their salary, so 2/3 of their salary, with the employer only paying national insurance contributions and their pension. If you're outside of those tier 3 areas, subject to tier 2 lockdowns, then the scheme is significantly less generous. So that the scheme under those sort of areas has the government and the employer coming together to top up the wages of workers who are on shorter hours. Now that also that scheme does dovetail still with the job retention bonus, where if you keep your workers on in sort of employment until the end of January, you get a bonus of £1,000 per employer. But our view is very much that if you take those sort of those two schemes together and compare them to the sort of job retention scheme, it does represent quite a significant decline in the generosity of what's available. And I think certainly as far as employers are concerned, it very significantly weakens the incentives to return, particularly if you're in one of those sectors which is operating well below normal capacity. So we think there'll be quite a substantial pickup in unemployment at the end of this year. Our forecast goes from 4.5% now to just over 7%. And I think that certainly the risks are that we could see an even greater sort of fallout than that, particularly if we don't see any sort of more support for these areas that are outside of tier 3 restrictions. I think under those sort of circumstances, you could see quite a few people, particularly in these arts and hospitality sectors, being made redundant. Now, in terms of sort of the end of the scheme and the reduction in generosity, it's not really a sort of case that the government's been forced into this. This is very much the sort of the government's choice. Certainly, I think in terms of the sort of the fiscal landscape, there's nothing really that's sort of screaming red at the moment. There's nothing that's forcing the government to be less generous in this way. Certainly, I think if you sort of think about sort of how the government is acting in other areas, so PPE in terms of test and trace, we're very much in the sort of stage of the sort of the process at the moment where the government is spending whatever it feels it has to do in order to sort of keep the economy afloat. In addition, we don't sort of see any particular need for austerity in the near term. So I think certainly there's a sort of sense that the government should allow really the recovery to breathe when it starts to sort of ratchet up as the pandemic sort of comes to an end. And I think any sort of austerity certainly I think should come quite a lot further down the track. Now, I think the justification for that sort of view comes with this chart here, which shows the government's own fiscal rules. And I think I'd draw your attention in particular to the third of those, the dead interest to revenue rule, where the government effectively tries to take a sort of more private sector sort of approach to its finances and thinks about sort of debt servicing costs and sort of uses that as a sort of barometer for the sustainability of public debt. And there, certainly our forecast suggests that even on a worst case scenario, debt servicing costs are unlikely to spiral out of control. So certainly, I think we would suggest that there is no obvious need for austerity, and certainly I think if the government were to go down that track, it would very much be a political choice rather than something that was out of economic necessity or something that was forced upon them by financial markets. So that's sort of the first of the sort of the uncertainties and the sort of the sort of assumptions that we've had to take around sort of the path of the pandemic and the government response. Obviously, the second sort of uncertainty is around Brexit and where we go from here. And again, a scenario-based sort of approach is certainly the most obvious one to take on this as well. But our baseline forecast is that there will be a free trade agreement put into place that comes into force at the start of next year, and that free trade agreement will be relatively flimsy. We'll have tariff-free and quota-free trade with the European Union, but we won't have much success in terms of limiting non-tariff barriers. So that is something, as I'll sort of show you in a minute, which is quite a damaging assumption in itself relative to the sort of the current situation. But certainly we don't have the sort of the ultimate sort of endpoint, the no deal scenario as part of our baseline. Now, in terms of sort of why we have a sort of the free trade agreement as our baseline forecast, really there are sort of 4 reasons that I've got up on the screen there as to why we think ultimately the two sides will come to a deal. But I should stress that we sort of call this as about a sort of 60-40 call. So this is far from certain and certainly a huge degree of sort of downside uncertainty. In terms of sort of why a deal is more likely, the first thing and one of the things that is probably going to be most damaging in terms of both the political and the economic situation is that because of the withdrawal agreement that we've already signed up to, if we fail to agree a deal, this would mean some quite substantial frictions on trade between Great Britain and Northern Ireland. Now, obviously, that has quite substantial social issues. There are obviously big problems for companies that have their presence on both sides of the border as well. And certainly, I think that is something that the UK ultimately would like to try and avoid at all costs. I think there are quite a few sectors that are very vulnerable as well in the event of a no deal outcome. I don't want to dwell too much on this sort of issue because Jeremy will talk about sectors a little bit later. But certainly, I think our view is that sectors like chemicals, motor vehicles and aerospace would be significantly impacted by a no deal outcome. And certainly, I think they're all sectors that we would hope the government is really sort of actively thinking about and looking to try and mitigate that risk. And I think sort of politically, there are 2 big issues as well from this. I think, first of all, the government's had a terrible year. Virtually anything that could go wrong has gone wrong. Virtually every decision it's taken has gone wrong, and ultimately it does need a success. I think if we were to have a no deal outcome, yes, it might play to its sort of very hard Brexit base very temporarily for a short period of time. But I think ultimately the vast majority of people would see that as a failure, not least because of the platform that the government campaigned on in the last general election. And I think that the other point, the fourth point, then links back to that first point. We've heard a lot about the internal market bill and these threats to effectively ignore the parts of the withdrawal agreement that we've decided we no longer like. The problem with that sort of scenario is that it just drags Brexit out even further. It puts us in a situation where we have almost a never-ending sort of series of wrangles on the sort of legality of these sort of moves. There are lots of problems around the Northern Ireland border. Potentially, we could have a border then being introduced again on the island of Ireland. And we could have a whole series of sort of tit-for-tat trade disputes between the UK and the EU as well, sort of effectively retaliating for that sort of initial behaviour in ignoring the withdrawal agreement. So, one of the sort of successes the government had last year was sort of recognising that the country was tired of Brexit. It just wanted Brexit done. The government campaigned on that sort of issue. A no-deal Brexit would do the opposite. A no-deal Brexit would just simply drag this out further. It would be a never-ending saga. And I think certainly that there would be a significant risk politically to the government that under those sort of circumstances it would lose support of those people who are quite frankly tired of Brexit. But that's the sort of I suppose the logical situation as far as we see it. In terms of sort of how the government's thinking, it's not always that easy to get inside the minds of the government and to sort of really sort of think about things from its perspective. And I think that's one of the reasons the no deal risk is as high as 40%. And I think that the first issue on those sort of along those sort of lines is really that this government has proven that economic considerations are not the most important thing to it. The political aims, in particular, sort of around the pro-Brexit sort of sovereignty agenda, are generally seen as being the most important thing to this government. And I think that's sort of demonstrated by its decision not to extend the transition period. In the middle of a pandemic, the obvious thing to do would be to give companies more time. But by not doing that, I think the government has demonstrated that those sort of economic considerations just aren't the sort of the be all and end all that they may have been under previous administrations. And I think that the government could also conclude, and this is a point that I alluded to earlier, that the most damaging decisions have already been made. In terms of the economic impact, just sort of leaving the customs union and the single market sort of wreak the most damage. So once you've actually made those decisions, sort of as the government has done, then actually sort of signing a free trade agreement has relatively little benefit relative to those costs. So there is certainly a sort of a sense that the government may decide that the sort of the costs in terms of the sovereignty and various other issues just aren't simply worth bearing if it sort of makes them sign up to things that they don't really want. And I think that obviously the other sort of side of this is that we are sort of the government is almost sort of relying on the European Union to be the adult in the room and to continue negotiating sort of regardless of what's happening. The problem is that the threats to ignore the withdrawal agreement, this sort of constant sort of upping of the rhetoric, they are damaging trust over time. So there is always a risk at some point that the European Union will walk away, albeit we think that the risk on that basis is relatively low, given that I think the EU has made it quite clear that it wants to be the last one at the table, and if a no deal happens, that the blame wants to be attached to the UK. So just to sort of put a little bit of sort of flesh on some of those bones in terms of sort of the sort of situation post January the 1st, it is really important to note that we are sort of undergoing, certainly I think particularly for goods exporters, a sea change in UK-EU relations. Our estimates suggest that the increase in sort of the cost of sort of doing trade with the EU is of the order of about 6%, and that's coming from the imposition of customs bureaucracy, and also the extra regulatory sort of challenges that sort of leaving the EU and the end of the transition period will invoke. If we were to move to a no deal outcome, we'd then add another sort of 3.5% of tariffs, and then also a little bit more in terms of non-tariff barriers. So yeah, we are entering a very different sort of period now in terms of UK-EU trade. Now, in terms of the economic impact, a lot of that gets lost effectively in the sort of the COVID sort of impact. But certainly, I think if we were not to have COVID now, and if we were to just be showing our sort of forecasts sort of stable basis, you would see quite a substantial slowdown in activity in the short term as firms get over those hurdles. As I sort of mentioned, COVID really does sort of govern everything that's happening here. And this sort of chart here just shows our sort of baseline forecast where the free trade agreement is agreed, and also a no trade deal scenario. And we think the impact of a no trade deal scenario is to knock around 1% off the level of GDP over 2 years. That's partly from the extra trade barriers, partly from negative financial market impacts. But relative to what we've seen in terms of COVID, and relative to that 14% range on the scenarios I showed you early on, that 1% is pretty small. So certainly, I think it's something that is very much a sort of second order problem if we're thinking about things at the macroeconomic level. And in terms of the longer term damage, I think it's quite important to note that if we sort of think back to, this is a chart I presented, I think, to this group several times before. We think back to sort of how things were prior to 2016, prior to the referendum. We laid out, we did a sort of study that had a series of different sort of combinations of trade agreement and policy direction for the government to follow. And of the sort of the 9 options that we laid out sort of post Brexit, the government is effectively choosing between the 2 most damaging of those options. So we're looking at effectively a long-term hit to GDP of either 3% or 4%. Now, certainly, I think that does sort of does do things in terms of the sort of the incentives of government. That difference between 3 and 4 isn't particularly large, and certainly, I think if you're particularly passionate about some of the other things that you might think you might get from Brexit, then certainly that 4% might be worth sort of taking. But I think I suppose the message from this chart is that though the impact of Brexit may be smaller on a short-term basis than COVID, I think as we sort of come through the sort of the pandemic and as the sort of the world normalizes again, then certainly I think the hit to Brexit is probably going to be much more important if we're thinking about things on maybe a sort of 10-year horizon or so. So that's all I've got to say for now. I'll leave this sort of the main forecast numbers up there on the screen really as we go to questions. But the main sort of messages I say from the macroeconomic perspective are that the 2 big uncertainties are COVID and Brexit. In the short term, COVID is king. COVID will determine where we go from here, and really getting the pandemic under control is key to stronger economic outcomes. But as we move then into the longer term and thinking about things on a sort of maybe a 10-year perspective, then Brexit becomes important again. Does anyone have any questions?
So if anyone's got any questions, can I ask you to use the raise hand function, just so we don't get lots of people asking at once, and then we will just come to you. I've not had anything on the chat, just for reference. Anyone who's want the raise hand is the little hand icon, should be top right of your screen. I'm just keeping an eye on participants. Okay, looks like you might have got away with that one. Oh no, hang on, let's just have a quick look. So we've got a question from Kelly. So if I unmute you, do you want to fire away?
Hello, Andrew.
Hi there.
Yeah, I just have a question regarding the I think the focus of the GDP and industrial production. It looks there. I think if I look at the breakdown by quarter, it seems there is like a slump of the industrial production, and that's why it makes the significant difference for next year's focus. So you say GDP looks quite optimistic for next year. However, the industrial production, it seems not really catching up. I'm just wondering what are the reasons why we make a significant slump on the industrial production.
Sure. The sort of I suppose the strength of the rebound in 2021 partly depends on how bad your slump was in 2020. So part of the reason is simply that sort of the pandemic is almost acting a bit like an elastic band, in that the sort of the harder you pull down, the stronger you rebound. So part of the sort of the weakness in industrial, or the relative weakness in industrial production, is simply that it fell less than GDP did. But the other factor is Brexit. So it is this sort of idea that we are moving into a different sort of trading relationship with the EU, and certainly I think that represents a much bigger issue for manufacturers than it does for most of the rest of the economy. Obviously, if we're thinking about sort of goods exports, we are going to have to sort of deal with all of that customs bureaucracy come the 1st of January, regardless of whether we have a deal or not we're also going to have some quite substantial non-tariff barriers. The services sector will to some extent, but the non-tariff barriers there tend to be much lower. Obviously, you don't have customs or anything on the services side either. So certainly, I think we would expect Brexit to be a much bigger issue for the manufacturing sector and for industrial production in general than it is for services.
So, but even that is based on the eventually a free trade deal.
That's right. A free trade agreement does very little in the general scheme of things. It's better than no deal, but yeah, it's significantly worse than where we are now. We're going to have customs bureaucracy. We're going to have very large non-tariff barriers in some sectors. Lots of sectors where the barriers are very high in the European Union, like chemicals. This is going to be a sea change in dealing with the EU for these companies. And so even if we have a free trade agreement, I think the best we can hope for is that some of those non-tariff barriers are sort of just chipped away a little bit. But the vast majority of them will come in regardless of whether we have a free trade agreement.
Okay, good. Thank you very much, Andrew. Yeah.
Right, are there any more questions from anyone? There is another hand gone up, and that's from Jack Semple. So Jack, if I can ask you to unmute yourself.
Thanks, Andrew. Great presentation. One point, given in your analysis that the free trade deal has relatively little impact, how clear are you as to the government's thinking in terms of the opportunities if we don't have a free trade deal and they don't have their hands tied at all? And what impact might that have on the long-term future? And also I could add, how clear are you as to what the government's ambitions are in the event of no deal?
I suspect the government's ambitions and the reality of the situation are probably quite a long way apart. I think that's one of the challenges. I think the government is very ambitious about what it can achieve, but probably unrealistic about the scale of the economic benefits that would accrue from other free trade deals, and also probably not really engaging in the substance of what might be acceptable politically. On the second of those first, because it's quite easy to deal with, obviously, you think about the discussion around the US trade deal and the issue about sort of agricultural standards. It's quite obvious from that having a desire to have free trade and the practicalities of actually what it means and what you might have to sign up to are two very different things. And the government is well on board with the first of those and not really on the second. So I think that's going to be a challenge. I think things like the US deal are going to be very hard to push through without simply because there is quite a lot of opposition to this at home. Not least because people have been promised sovereignty. What the government doesn't seem to realise is that any trade deal will give up some sovereignty, and therefore, if we do a US trade deal, we're giving up some sovereignty on agricultural standards. In terms of sort of the scale of benefits that are available, certainly there would be some benefit from doing trade deals with other countries, but the benefits tend to be very low. That's partly because the sort of trade deals that we're talking about will be much less deep than they are than the current deal we're leaving with the EU. A lot of trade deals simply do sort of have tariff-free access, but tariffs are already very low and do very little in terms of reducing non-tariff barriers. And obviously, the other issue is a lot of the countries that we might be looking to do trade deals with are not particularly close. And we're sort of still in a situation sort of where gravity is a big issue for trade. So essentially, how much trade we do is largely a function of where your trading partner is and how big it is. So it's very hard to get beyond the fact that a lot of these countries we want to do trade deals with are either very small or very far away, or even in some cases both.
And Jeremy, I saw you had your hand up there, and I don't know if that was intentional or not, whether you had something to add.
I did have a question, but why don't you take questions from the rest of the group before you take mine?
Sure, okay. In which case, on my screen, I've got Javed with your hand up. If you want to unmute and ask a question.
Yes, thanks, James. Yeah, my question is, I mean, if you were to look into your crystal ball, how do you see the timeline developing as we move towards 1st of January? What do you think could be the possibility in terms of agreeing an FTA or not agreeing it? And then a secondary one is that do you see there could be any impact in the thinking of our government with respect to how the US election pans out?
Sure. I think in terms of timing, we've had some sort of artificial deadlines set by both sides, the latest of which was obviously last week's European Council meeting. But yeah, essentially, we do have a little bit more time. I think if we were to avoid a sort of fairly chaotic sort of process on the 1st of January, then we do need to get that agreement in place several weeks before. There are lots of logistical issues. At the very simple level, it has to be translated into sort of 27 languages, but there are other sort of logistical issues as well in terms of sort of getting the border sort of prepared as well. So I think certainly I would be surprised if it can go much beyond the end of next month. And I think certainly there'd be a desire to get the vast majority and the real sort of framework in place a long time before that, because we are talking about a very detailed agreement here. It's going to be hundreds of pages long. And it's something we can't just sort of put together in an overnight session of the European Council. In terms of the US election, I don't think there's going to be a huge amount of difference sort of either way. I think the best bet for the UK in terms of getting a trade agreement in place might have been if it had happened before the election, simply because it might have been something Trump might have wanted to sort of parade as a success. I think once we get beyond the election, the differences between the two in terms of what the US are going to ask for are not particularly great. I think we will be in a situation where the agricultural standards are still, even if Biden wins, are still the issue for the US. And it's very unlikely that they will give us much or give us anything at all unless we're willing to actually sort of lower agricultural standards and do something that allows some of these US products in. So I'm relatively gloomy on the US trade deal. I don't think there's the chances are particularly high. Even if Biden wins, and even if we don't have a sort of very Trump sort of taking the sort of very aggressive approach to trade that he has done recently.
Thank you.
Good stuff. And then, Jeremy, if you wanted to add or ask your question, fire away.
Yeah, just briefly, Andy, because you mentioned the fiscal situation, how there's not a whole lot of pressure on the debt servicing, and I'm just looking at the long-term interest rate, and clearly they are quite low to 2023. But what are your thoughts? What are the risks around sudden increases in interest rates, and looking out maybe second half of the decade? Is some of the spending that's happening now could that become a long-term risk to the UK economy?
We're relatively sort of relaxed about the debt situation. I mean, I think certainly in terms of sort of long-term interest rates, then there's a whole series of factors which suggest they're going to remain low. Quantitative easing isn't going away anytime soon. There's no chance we're going to sort of to reverse it. There's still quite a lot of demand for safe assets, and that demand, if anything, is increasing over time rather than decreasing. And we certainly think as well that inflation will remain pretty low. So I think all of the sort of factors that could put upward pressure on long-term interest rates are either absent or actually pushing in the opposite direction. So we think long-term interest rates will remain pretty low for quite a period of time. So I think it does become more of a sort of political issue. It becomes partly a question of sort of what the Conservative Party think is a sustainable sort of fiscal policy going forwards. Are they prepared to have a debt ratio that it's over 100% of GDP, or do they think we need to lower it? And also, I think there's a sort of secondary consideration in terms of the shape of policy that the government wants to pursue. Obviously, it's very keen to spend a lot of money on levelling up the regions, so big capital spending projects outside of London. But I think even if we sort of take our view that there's no real need for austerity, then certainly if you want to pursue these sort of capital projects, you might have to compromise elsewhere just to sort of keep the sort of the deficit at the level that it was planned to be sort of prior to the pandemic. So that might mean then squeezing day-to-day spending, or it might mean tax rises as well. So there are some difficult sort of decisions ahead for the government if it's really sort of keen to continue pursuing this levelling up agenda.
Thanks.
Great stuff. Well, thank you very much, Andy. That's very much appreciated. I think you're still staying around to the end, aren't you?
That's right, yes.
In case there's any additional questions, then people can ask those. But for the time being, we will now move on to the industry outlook, which Jeremy, who you just heard from, is going to present. So this is obviously looking at the key industries of customer industries for our sector. So Jeremy, I'll hand over to you.
Great, thank you very much, James, and good morning to you all. I'm going to continue on. I think Andy set the stage very, very well. In this unusual public health recession, sectors matter greatly, and the behavior of sectors is very different to what we might expect in a more traditional downturn. So I'm going to spend some time talking about that and drilling down some of this sector discussion to the ones that matter to the membership of the MTA. So we'll take a global view to start, just to see where we stack up, because things are happening very differently depending on which region of the world you look at. We'll take a closer look at UK sectors, and then I'll spend a little bit of time talking about the implications for machine tool demand. I don't normally do this, but I think it's worthwhile just because even within the machine tool markets, if we look across Europe, they're very different profiles. And I just want to illustrate the importance of the relative importance of sectors and how that affects the outlook. And of course, then leave the detailed discussion of the UK to Jeff. But just looking a little bit at recent industrial trends, you can see from this chart that we're in unprecedented times, as we all know. What's interesting here is that we talked about rubber bands and bounce backs, and one of the things that we've seen in industry, we've seen an extremely rapid recovery in recent months with respect to production. So if you focus here on the blue line, you can see that the downturn was quite a bit deeper than the global financial crisis, though not so much so as for the overall economy, as we just saw from Andy. Part of this is due to the fact that this has fundamentally been a services-led recession. Of course, industry has been caught in the downdraft through indirect factors that I'll go into. And one of the other things you can see, which is a little bit concerning, is you can see that growth has tailed off a little bit if we look at the latest data in August. And that's signaling to us that this decline in momentum that's coming, we saw that pattern in Andy's presentation, and we actually see it quite a bit more on the industry side. And we'll talk through that as well. You can see here, though, that if we compare the industrial recovery globally compared to the global financial crisis a little bit more than a decade ago, you can see that the strength of the rebound is really quite astonishing when we think about it. So, you know, globally, we're kind of up getting close to, 94%, 95% of the level that we were at prior to the pandemic, which is much higher than for the economy as a whole. Now, this can be a little bit illusory, and we shouldn't read too much into this, because there is a factor going on in manufacturing, and that's one of pent-up demand. Because obviously, if we think about an economy shutting down, there's some kinds of things that stop happening, such as people going out to restaurants and taking vacations, that likely aren't going to be recouped afterwards. So in other words, people aren't going to take twice as many vacations after the pandemic or eat out twice as much. Whereas on the manufacturing side, if consumers have wanted to purchase something and have been unable to because shops are closed or they can't otherwise procure it, there's considerable pent-up demand. And that's essentially what we're seeing right now across many countries. In fact, it's quite striking that the level of automotive production in many countries is actually as high as it was prior to the pandemic. This isn't a signal of a fundamentally super robust demand. It's simply a signal that a lot of manufacturers are clearing backlogs that piled up during the period of the lockdown. And you can see this in the composition of consumer spending, and this just gives you an example from the United States. If we split that between goods and services, you can see that the purchase of goods is much, much higher, and this does reflect the pent-up demand. So purchases intended during the lockdown have now been made, and manufacturers are clearing those backlogs. But secondly, and not unimportantly, the fact that people aren't spending their money on things like high contact services like sporting events and going out to the cinema, et cetera, that actually households have more money to spend on goods, and that's actually providing, at least in the very near term, a boost to manufacturers of consumer goods and associated supply chains. So the question on the industry side is, can the momentum last? And I think to give ourselves some clues to that, we can take a look at the China situation, because as we know, China entered the worst period of its pandemic and lockdown about 3 months prior to the rest of the world. So on this chart, I've overlaid the China industrial production data, but I've advanced it 3 months so we can give ourselves some clues as to what might happen in developed economies. And you can see in China a pattern of a very strong initial near-term rebound. This was brought about both by the pent-up demand factors that I just mentioned, as well as a very aggressive policy stimulus that was focused very much on construction and heavy industry, as is typically the case in China. But you can see that as we move through to the present, that momentum has tailed off, and you can see actually that industrial production in China has started to flatline again. So now that this pent-up demand has been exhausted, it's now coming up against the fact that broader demand in the global economy is not as strong as it was prior to the pandemic. And I think that gives some pretty good clues for the US and Eurozone, and we can certainly see in the latest data in August that there has been a tailing off of the growth in industrial activity. And so part of this is the momentum, and part of it is the fact that the stimulus in the U.S. and Eurozone has been, if not less aggressive than in China, certainly much less focused on industrial-facing sectors. A very worrying trend from my perspective, and I think from the perspective of people on this call, is the patterns in the investment cycle. So this chart is illustrating that by showing you the capacity utilization in manufacturing across the developed world. And I think there are a couple of important points on this chart. The first one is that if you look at the period just prior to the pandemic, throughout 2019, you can actually see that the CapEx cycle was already starting to peak. We were seeing increasing spare capacity throughout last year as industry weakened, and that, of course, had an impact on investment demand. And so what it means is that even before the pandemic, the incentives for additional investment were actually low and decreasing. The second factor is that if we look at the latest data, which is sort of the estimates for Q3, that rebound in capacity utilization has been much less pronounced than on the production side itself, which signals to us that even with this bounce back, there's still a considerable amount of excess capacity. And of course, this bodes very poorly for investment looking ahead, because it suggests that now that we have industrial activity losing momentum on the production side, the fact that we still have a huge amount of spare capacity means we're likely to see very weak investment in the machine tool sector, but across all industries. So this is kind of the key worry that I have, and the reason why I think we're facing a pretty downbeat situation in terms of the sectors that are consumers of machine tools. Just to show, though, the focus of Chinese stimulus, you can see tracking here some of the key economic indicators that show the stage of the cycle. And you can see very clearly that industry and the investment side of the economy have recovered very, very rapidly in China relative to retail sales. Now, it's very heartening to see that retail sales have picked up considerably in recent months. But this illustrates something that has been true in the past, which is China has been a kind of motor of industrial activity elsewhere in the world. And I cite countries like Germany, who've become very important exporters. One of the things that's happening in China, though, and this is partly to do with some of the trade actions taken by Mr. Trump, is that there's been an increasingly domestic focus of production. And this is happening in the machinery sector. It's happening in many sectors where China is seeking to move up the value chain and increase its strategic importance. And so one of the things that we've seen is that this increase in industrial activity in China is not really filtering so much to export demand in some of the traditional markets like Germany and to a lesser extent the United States. So again, this is good for the Chinese economy itself, but we're doubtful that China is going to be able to pull the world economy out of this recession in the same way that it helped to do so during the global financial crisis. So if we think about the factors influencing the industry outlook, a lot of them are very similar to what's happening at the macro level. The depth of decline in some part will determine the size of the so-called mechanical rebound in the near term. An important aspect that I've mentioned, but I want to just stress, is this pent-up demand. We are seeing quite an acceleration in consumer goods sectors. But as we look ahead and as lockdowns get eased, we hope, and we certainly assume in our baseline into next year, that actually that social spending is going to crowd out some of the spending we're seeing on consumer goods. So obviously that's going to be a headwind for manufacturers. But again, the key point from the perspective of this group is the large amount of spare capacity that we expect is going to persist longer than the gap in production. Capital equipment producers will take longer to rebound. There's also the additional point about corporate finances and the stresses there, the risks around layoffs and associated costs. And I'll just mention that construction is set for a strong recovery because of the fact that it's easier to social distance. A lot of the sites are outside. And as Andy mentioned, certainly in the UK, there's been a lot of government commitments in terms of increasing construction, in terms of the building and leveling up the regions. But again, I recognize that that's not such an important sector for the machine tool industry. So if we look at the shape of the global industrial recovery, this chart is basically showing you across the key goods producing sectors the depth of the downturn. So in the fourth column, you see the change from Q4 2019 to second quarter of 2020, and then we kind of track the speed of the recovery. Where we can see that industrial production as a whole, we expect to get back to its pre-pandemic level by the third quarter of next year, and you can see there's quite a wide dispersion around that, depending on what sector you're looking at. So clearly there's some that are, I would call, kind of winners in the sense of some of the staples and essential goods like food and beverage. Pharmaceuticals, obviously, with the development of a vaccine and the need to stockpile medicines and things of that nature, and high-tech goods as well. So this is things, the things that make these kinds of virtual meetings possible. So there's quite a few sectors who have been relatively shielded and are expected to recover quite quickly. But unfortunately, most of those are outside of those in the red rectangle, which is really the key ones that matter to the machine tool industry. And so you can see, particularly, I highlight automotive, aerospace, and mechanical engineering. And so, aerospace is one where, the impact there is due to restrictions on travel, which are likely to persist far longer. And that's really a very clear indication of disruption in a service sector, which is having big secondary effects on the manufacturing sector. And a similar story can be told in automotive, which itself was kind of reaching the peak of a demand cycle even before we came into the pandemic. But I think the mechanical engineering sector, that's really the story about this CapEx and spare capacity in the economy, because you can see that the downturn itself wasn't as dramatic as some of the ones that were touched by the impacts of restrictions, but at the same time, the recovery is going to be significantly slower. And this does come back to the fact that we think that spare capacity across manufacturing is going to be more persistent. Another way of looking at the risks across sectors is something that we've done in some of the research we've been doing that looks at not only the change in output, but looks at the vulnerability of sectors in terms of its cash flow, its debt levels, the degree to which social distancing can be practiced in the workspace. And so you can see on the y-axis that it's sort of a composite recovery score that's a weighted average of those various factors, and that's plotted against the actual change in output that we expect from the end of last year to the middle of next year. And so you can see aerospace, in addition to being very affected in terms of output, is also under tremendous cash flow pressure, and indeed has often been slow to recover in previous recoveries. So you can see again here that kind of three of the key machine tool consuming sectors are in the bottom right quadrant of this, whereas you see some of the staples and some of the sectors I mentioned before. Not only are they subject to better demand conditions, but also prior to the pandemic, they were in better shape in terms of their debt levels, their cash flow, and their ability to weather the crisis. So in some sense, you have the worst of both worlds, and the sectors who were most vulnerable in terms of their finances were also the hardest hit in terms of their demand. So here we have it, just the industrial production forecast. You can see 2020 big negatives across the board. Those numbers are generally a function of the severity of the lockdowns. Of course, the only exception is China, where of course with the aggressive stimulus and the early onset of the pandemic, we'll manage to eke out positive growth this year. And then if we focus on the UK, you can see next year not going to be as strong as most other developed countries. And Andy already sort of alluded to that, and I'll come to the reasons for that and talk a little bit more about Brexit at the sector level. But again, just to repeat what Andy mentioned, similar story on the industry side in terms of the bands of uncertainty around our baseline forecast. I've gone ahead and put in the second wave scenario just to give you a flavor, because I think that is a scenario that a lot of us are worried about these days, and certainly we're seeing indications in terms of infections that is potentially an increasing possibility. That scenario does assume that we do kind of enter into national lockdowns towards the end of this year, and would result in a W-shaped industrial recession, and the recovery itself would be not too much stronger than our baseline, which means that you'd see a gap in the long term of sort of approaching 5% of global industrial production. So a quick closer look at the UK, and I think I put up this chart, which is familiar. It's a version of that global chart I showed earlier, and you can see again here the wide dispersion around that kind of number for industrial production. And I think the biggest ones here to point out are that if we look at that recovery profile in terms of the speed that we get back to pre-pandemic levels. Here we're looking at the first quarter of 2022, because that's the point at which the broader economy reaches its pre-pandemic level. And you can see the first point is that industry itself is going to perform less well. This is a direct consequence of Brexit, but you can see that in automotive, aerospace, and investment, those numbers are even lower. So essentially, even looking out to the beginning of 2022, we're still going to have the level of activity about 8% lower than it was at the beginning of the pandemic, or should I say at the end of last year. So, yeah, this is very concerning, certainly for the UK market itself. I think another point worth mentioning is the extraction sector, which has come back, as Andy mentioned, in the very near term. The pressures in the extraction sector revolving around the oil price that mean that even though the downturn was relatively small, certainly given the gyrations in the oil markets, if we look at where we are out in 2022, quite low, even lower than in automotive and aerospace. So I think it's worthwhile just spending a couple of minutes on that, because I know that some machine tool producers sell into the oil markets, and you can see, of course, we all know that the pandemic was accompanied by some gyrations in terms of supply decisions by OPEC earlier this year, which sent prices tumbling towards $20 a barrel. And they've since recovered, but they're still at a very low level. And this clearly reflects the collapse in demand that we've seen, because fewer people are driving and flying. And you can see that had a direct impact on the U.S. unconventional market. So rig counts, which tend to track that, are very far down. So investment in the U.S. has really collapsed again. Companies have cut back operations, and indeed some of the bigger players have declared bankruptcy. So in terms of the investment in the oil sector is set to be very weak. So not only in the U.S. but elsewhere, and I think in the UK as well. And just show this chart briefly. It's not ours, obviously. It's from Oil and Gas UK, but the impact of the fall in the oil prices on UK producers, expecting post-tax cash flow of essentially zero this year, and that's causing big problems for investment. We have seen production go up recently because a couple of new fields have started producing, but if we look into the future, there are very few, there's very little new investment happening. So I think oil and gas is another one, maybe a smaller market for the machine tool, but again, one that is facing big structural problems, especially in the US and the UK. So Andy talked quite a lot about the assumptions around Brexit. I just put up this chart to show the stark difference between industrial production compared to the rest of the economy. So again, you can see here that in the UK, as in most other developed countries, the recovery in industry has been much more rapid. You can see that clear pent-up demand coming into July and August. You can see that backlogs have essentially been cleared. We see there will be a little bit of stock building prior to the end of the transition period, as we saw with some of the other artificial Brexit deadlines that came and went in the past. But then beyond that, we see the impact of the increased customs and non-tariff barriers costs will have a direct competitive impact on UK manufacturers, and that's really the main reason that you see a pullback, a kind of mini cliff edge in January, and then you see that growth rate compared to the rest of the economy is significantly lower into the medium term. So if we look at the assumptions around a situation where we reach a free trade agreement, that is to say that tariffs on goods are zero, you can see that across most sectors, it's really the customs costs, which, as Andy mentioned, are a little bit more than 4%. So in the machine tool sectors, you can see because the regulatory requirements are not so large as for some other sectors like chemicals and food and beverages, the direct impact in terms of direct competitiveness is going to be smaller than in some of the highly regulated sectors. But I think at the same time, particularly if we think about the automotive sector, something that's very difficult to quantify is just-in-time inventories. So in some sense, customs checks of about 4% of total value, that seems like a small amount monetarily, but if we're thinking about goods crossing the border multiple times, needing to have inventories coming in practically real time, that those monetary costs actually translate into time costs and potentially will encourage companies who are serving continental European markets to migrate away from the UK over the medium term. So if we look at the export intensity here, you can see, interestingly, if we look at some of the machine tool sectors, aerospace and machinery, exports to the EU are a significant portion of that. But perhaps a silver lining to all of this is that exports to the rest of the world are also very important. And in this, I specifically point out the aerospace sector. So obviously, there's a lot that happens. We think of Airbus and manufacturing wings, but there are an awful lot of UK aerospace providers of testing equipment, flight simulators, all sorts of equipment that's going elsewhere. So I think there's if you want to look for a silver lining, there is that. But it's nevertheless clear that trade intensity with the EU is quite large, and so that's the reason that Brexit is going to have the impact it will. And just to illustrate some of the supply chain disruption potential, coming back to this point about the harder to quantify time costs, this is just showing you the UK auto sales to the rest of the EU, or I should say to the EU, by plant. And you can see that the Sunderland plant is a very important one. And the point being here is that because it's not only the sales of the final vehicle that cross the channel, but it's the components that are often sourced from places like Germany, France, and Italy that are crossing the borders multiple times. When you start adding up that 4% on each crossing of the component, that can rapidly add up to quite a large competitive disadvantage. So I think this gives you a good sense of which manufacturers might be most at risk in terms of their competitiveness. So I want to talk very briefly about the implications for machine tool demand outside of the UK. And I put up this chart just to illustrate the difference in the patterns of recovery here. So quite interestingly, you can see that France and Italy are exceptions to what has been a fairly shallow machine tool production if we think about production. And normally Germany, which is the biggest market, typically leads in recoveries, and we're not seeing anything of the sort. And so what this really comes to is the point that Andy raised about the sectoral story being key. And so I put up here on this chart, it's basically the composition of sector investment across some of the key machine tool using sectors for Germany and France, who you saw had very different profiles in the near term. And you can see that the first thing that jumps out is that Germany has a huge share of that investment is concentrated in the automotive sector. And we've seen that that is a sector that had the biggest downdraft. It's coming back, to be certain, as backlogs are cleared. But if we look into the medium term and the shift to electric vehicles and the various emissions regulations that are encouraging, indeed giving serious financial incentives to invest in electrical vehicle production capacity, that's having a very adverse impact on Germany, and one of the reasons why the recovery in Germany is likely to be more shallow. If we turn to France, however, we can see that there's a not insignificant portion in precision and optical instruments. So these are things like test and measurement. It also includes things like medical devices and other things that have been affected much less dramatically, and actually due to the incentives for automation and the prospect of possibly needing to social distance for some period of time, that's actually worked to France's benefit in terms of machine tool demand, and indeed is one of the reasons why the French outlook next year is likely to be quite a lot stronger. And you can see that the motor vehicle component there in France is much smaller at less than 20%. So the mix of investment is very important, and I know Jeff is going to come back to that in his presentation, so I won't dwell on it. But just to illustrate where the UK stacks up, Jeff's going to talk more about the UK market, but I think the thing I want to point out here is that some of the markets who you maybe wouldn't have expected to perform so well in the recovery next year, such as Italy and France, are actually going to lead in terms of the machine tool recovery. Part of that obviously is due to the mechanical bounce back effect. The strictness of the lockdowns means that there's more ground to gain back. But the other piece of that is the sector mix. And you can see that's in sharp contrast to Germany, which actually its drop was fairly large, even larger than the UK. But the rebound for 2021 is significantly smaller, and this does come down to Germany's heavy dependence on the automotive sector, combined with the composition of car production that is going to swing more towards electric vehicles that arguably will need less machining to produce. So just some key takeaways. I think first thing to point out is that we have had very strong industrial growth in Q3. We are entering a second phase of more moderate growth, so I don't think it would be a good strategy to try to trend out the growth that we've seen today. Those lockdown-driven backlogs are being cleared, and the underlying demand conditions that await manufacturers after that are significantly weaker than they were than when we came into this pandemic. And the key point is that the CapEx cycle was already past its peak prior to the pandemic. And so the incentives and the ability to invest will be quite weak. And indeed, those sectors, so if we think about mechanical engineering, are going to be the ones that lag the recovery. And again, this is often atypical of recoveries, where you'll often see a sudden improvement in investor and business confidence and having investment leading recoveries. That's not going to be the case in the current situation. And then, of course, sectors with exposure to contact-intensive activities will continue to face headwinds, because a lot of travel restrictions are unlikely to be eased as quickly as some of other social distancing rules, and aerospace in particular has been caught up in that. And so that is also a sector that is going to lag considerably. And the final point, I'm not going to dwell on it too much. We can discuss it more if you'd like, but these structural shifts towards electric vehicle production is posing challenges to machine tool producers. In our global machine tool report, we talk quite a lot about this, and we've incorporated assumptions about the big investments that are being made, particularly by some of the German manufacturers, and what the potential implications are for total machining demand. So I'm going to leave it there and open the floor up to questions.
Thanks, Jeremy. There's some really interesting stuff there. Are there any questions? If anyone would like to use the raise hand function again, feel free to do so. Just having a quick look on the chat to see if there's any added, but I haven't seen any. We'll just give that another couple of seconds because my computer is catching up. Doesn't seem to be anything coming through at the moment, but again, if people have got questions, I know Jeremy's around till the end. We can always take this. It might be that something following Jeff's presentation comes out of this, so we will we'll pick up then. So Jeremy, thank you very much for the moment.
Thank you.
And I will now ask Jeff if we can hand over, who will give us an update on the manufacturing technology industry and the cutting tools forecast. So Jeff, if I can hand over to you.
Right, hopefully you've got my presentation there. I'm just going to start with a couple of more or less reference slides, which I will say very little about, but these are just a reminder of what our forecasts are based on. Both the MTA forecast document and the global machine tool documents will be available on our website within an hour or so of the end of this presentation. And we will, of course, be making this recording available as well for members to access. And also just a quick reminder on the assumptions. We've talked a lot about them. Jeremy's mentioned them. Andy started the conversation around these. But these are the baseline assumptions based on the coronavirus situation and around Brexit that lie behind our forecasts. So this essentially is where I want to start, and it's actually more or less Jeremy's chart turned on its side. I prefer columns, he prefers bars, but it's the same chart really, slightly different country mix. Really a few points to make, additional points I guess to make arising on this. Perhaps the most surprising is actually that the UK has seen a relatively, I mean minus 24% is still a pretty big number, but compared to say Germany and Italy and India, for example, it's a relatively small fall in the machine tool demand, and I must admit it surprised me when I was putting the numbers together on this. You can see also that China is a bit odd. There was a very large fall in the Chinese market actually in 2019, which is the blue columns, and a relatively small one is then forecast for 2020. If we then add the forecast for 2021, you can see what Jeremy was alluding to in terms of the different recovery patterns and profiles. These are percentage changes, and one thing I should have added is that the MTA forecast document was produced a couple of weeks after the global machine tool forecast, and therefore benefits from having a little bit more data, both in terms of the machine tool market and some of the inputs to the forecast. and actually we now have a lower recovery in 2021 in the UK than is in the global machine tool forecast. So if you're specifically interested in the UK, then you should look at the MTA document when you review these forecasts. But then also bear in mind, if you're looking at other countries around the world, that you just need to check the UK against the slightly more updated forecast. It's almost inevitable in terms of a fast-moving situation. The other point I want to make on this chart is probably around the USA. The UK and the USA have a similar fall in 2020, but the US, as you can see, has a much stronger recovery in 2021 than the UK does, and as we've heard from the previous two speakers, that's largely a Brexit story and a policy response to COVID story as well, mixed in with the various sectors, as Jeremy illustrated. A reminder that the drivers for the MTA forecast, indeed for the machine tool forecasts globally as well. We have a focus on investment, which is the main driver for machine tool demand, and also a focus on output, which is the main driver for cutting tools. Now, we're aware that there are many members of MTA in the manufacturing technology industry who don't sell either machine tools or cutting tools, but the general principle is that your business will be driven by some combination of investment and output, probably tweaked towards one or the other of those. Investment is a factor in cutting tool demand, but output is a bigger driver, for example. And so you can adapt those forecasts. You can look at what the profiles are likely to be. You're looking at output data, or you're looking at investment trends to determine the driver for your own particular product. And of course, the four industries that we normally cover. So I'm going to start with investment, and here we're limited to relatively high level data. There is a breakdown for manufacturing as a whole in the investment data in the UK, and within that there is also a breakdown for the engineering and vehicles industries, combined together as one block that's not split out. Now, on the face of it, you look at this chart and you think, okay, well, that's what I expected. But I want to draw your attention to the title, in that this chart only goes up to the end of March, so Q1. So there's not a lot of COVID impact in this particular data set. Unfortunately, this is the time of year when the Office for National Statistics rebases all its economic statistics. And when it published the Q2 data for the economy on the new 2018 basis, it didn't, unfortunately. It should have done, but it didn't publish the breakdown of investment. What we do have is a higher level measure of investment data for total business investment. And you're now now we're talking in terms of tens of billions of pounds as opposed to billions of pounds on the previous chart. So it's a much broader category. And within that, we do have some indications around investment by asset type and the very broad heading of information and communications technology and other machinery, ICT and other machinery. Here you see what you would expect to see, a very sharp fall in the second quarter. But I want to remind you of the previous chart. I'm just going to go back to it for just a moment. That was the picture that we saw in the first quarter for manufacturing investment. Now, this data is notorious for being revised, and particularly at the industry level, and I wouldn't be surprised if we see quite a different profile when the Q2 investment data is eventually published for the industries. But nonetheless, it does give an illustration of one of the difficulties we had in compiling the forecast, in that we've got somewhat mixed messages going on, as well as a lack of detail in the most recent data. Normally at this point, we would go on and look at investment intentions. And here there is a slight problem in that the latest data is due out on Thursday, so fortunately isn't in this chart. But given all the gyrations around COVID that have happened through the last 6 months, this chart is probably less useful than it usually is, although there was some recovery in the July reading compared to the bottom of the cycle in April. It is worth noting that April saw investment intentions far weaker than was recorded at the bottom of the industrial crisis, financial crisis, sorry, which you can see back in 2009. Although the recovery looks to be sharper as well. Jeremy talked about capacity utilisation data, and there is a strong link in normal times, at least, between the machine tool market and capital utilisation. Although this is labelled as to 2020 Q3, it's actually data that was published in July and largely collected in the end of June, first couple of weeks of July. So unfortunately, the publishers of this data tend to use the quarter in which it's published rather than the quarter in which it was collected. And the machine tool market isn't falling as sharply because that is a 4-quarter moving average. The pale blue, the thin blue line is a 4-quarter moving average. So we will see that move downwards despite a stronger third quarter of the year anyway. So moving on, this shows the investment forecast for the capital goods industries, which is our 4 key industries, plus things like electrical machinery, electronics, or some electronics, which make up the capital goods sector. You can see, and I've left in our April forecast, although, as I say, things have changed so much. And the main point to make here really is that you can see that investment is now expected to be much weaker in 2020 than we anticipated earlier in the year. And although we have a recovery in 2021, the size of that, strength of that recovery hasn't actually been upgraded much. Going back to the points that Andy and Jeremy have made about mathematical bounce, in theory, the larger the fall, the stronger the bounce should be, simply because you're comparing with a smaller base. It's much easier to get a bigger growth rate on a small base than it is on a large base. So despite that effect, you can see that the outlook for 2021 hasn't really changed very much. And what that really implies is a downgrading of our investment outlook forecast. That's really as far as the data and our forecasts take us in terms of investment. So I'm going to turn now to looking at output. And in some cases, we have to use output as a proxy for some factors within the machine tool forecast, where we don't have detailed data for investment. And I guess the starting point for that is to look at the Purchasing Managers Index. Although there is a question mark, as I say in the title to this slide, there is a question mark over how useful the Purchasing Managers Index data has been in the current crisis. And there are really 2 factors going on here that lead to this question. One was, how were people answering the question? The Purchasing Managers Index is supposed to be a month-on-month change measure. So you're being asked against 5 different factors, 2 of which are output and orders, and then there's also employment and stocks, and I'll come back to stocks in a minute. So how was last month compared to the previous month? Well, in April, as you can see, the Purchasing Managers Index fell to something around about 32 point something, which is as you expect. April was terrible compared to March because basically the economy had been shut down. But then the PMI reading in May was 40.7. Now, the significance of that is that any figure below 50 implies a month-on-month contraction. So a PMI reading of 40.7 in May implies a significant reduction in activity compared to April. Not if May had been the same as April, the PMI should have been 50. And indeed, the PMI did reach 50 in June. So what the PMI is telling us was there was a very sharp fall in activity in April, another sharp fall in May, which doesn't seem to bear logic. And then in June was no better than May. And that really is an issue. And we see it in other countries' PMI. It's not unique to the UK, but the UK does illustrate it quite well. The other problem, and this is a more technical one, if that's possible, is that one of the indicators in the Purchasing Managers Index is the level of finished goods, stocks of finished goods. Now, normally when the level of stocks of finished goods falls, that's taken as a positive sign because everybody's bought them. In fact, of course, what happened in the current crisis is that stocks of finished goods fell because they weren't being made, because factories had been shut. So what should have further reduced the PMI was in fact helping to support it, because of the way a conceptual issue around how the index is driven. So bearing in mind that the PMI has not been a terribly good indicator, particularly around the turning points, we will take a quick look at what's happening elsewhere in the world on the PMI. And you can see a similar pattern for the Eurozone, which is actually a combination of 8 countries, not the whole of the Eurozone, but is still a useful indicator. I think the other important thing to say here is that, and you see it more in the Eurozone, but it is also there in the UK figures, is that it had been below 50. In other words, the manufacturing sector had been contracting for some time. In fact, the Eurozone was below 50 since February 2019, not 2020, February 2019. And the first reading of the Eurozone PMI above 50 didn't come until July 2020. So in that entire period, you can see it in the purple, on the purple line in the right-hand chart, of manufacturing activity in the Eurozone contracting have been going on for some time. And indeed, the UK only escaped that by having a couple of good months in January and February 2020, immediately before COVID struck. Another concerning thing about the PMI index, not so much around the current crisis, but throughout 2019, is that weakness in the Eurozone was being driven by Germany. Germany, there's a lot of lines on this chart. And I apologise to some extent for that. But if you look at the black line through 2019, the black line, which is Germany, is clearly the weakest of the 7 countries that I've put on this chart. I haven't included Greece, as it's not exactly a manufacturing powerhouse and would only add to the problems of viewing the chart. And that, as you would appreciate, for manufacturing industry, for the capital goods sectors, is an issue. If Germany is not doing very well, then there's the locomotive is not driving the train. And for the sake of record, I won't say too much about this, but you can see fairly mixed pictures globally. Brazil and Mexico are probably the 2 extremes of the cycle. I think the only thing I really want to comment on this particular chart is the strength of China, which, as you can see, has been above 50 well, since March. In fact, it only had 1 month below 50, and that was February 2020. And you can also see that although India, which is the orange line on the top left-hand chart, had the sharpest decline, it's also had the strongest recovery in the PMI since that point. This starts to bring us to our forecasts, and you can see here the output forecasts for total manufacturing, which of course, as you will know, includes a lot of things, including chemicals and food and drink and all those sectors that were on Jeremy's table. And then for the investment goods sector within total manufacturing, and investment goods is about 30–35% of output. It varies a little bit from period to period, but it's of that order. It's the share of total manufacturing. And you can see here that although, particularly for total manufacturing, the 2020 outlook hasn't actually changed very much since earlier in the year, the recovery in 2021 is significantly weaker than we previously expected. For investment goods, you do see a slightly stronger downturn in 2020 than we've had before, but you also see the weaker recovery in 2021. That then is the high level outlook and situation. I want to now start to delve into our 4 key industries, and regular viewers and regular attenders at our forecasting events will be familiar with this chart, which tracks month on month at monthly output levels for the 4 key industries. You can see here the extent of the crisis in the automotive industry, and I'll come back to that in a few moments. By far the worst affected, as it was in the financial crisis in 2008, 2009, and the current decline, both much steeper but also shorter, so far at least, for that industry. But you can see an impact on all the industries, on machinery, which is the red line, on aerospace, which is the purple line, mauve line on this chart. I should say this set of data is one that has recently been included in the revisions from the ONS. So we now have a spike in aerospace activity in January and February of this year, particularly February, for reasons which I have to confess I don't really understand, because I never really understood why aerospace output was relatively weak through 2018, 2019 either. But just to say, that February 2020 figure for aerospace is actually the second strongest ever recorded for that industry, behind only the spike in May 2018. And that will be important when we come to look at the recovery profile for aerospace in a few moments. So let's move on to the automotive industry. I mean, as we've already heard, the automotive industry facing multiple issues. Far too many to get on one slide, especially one that's going to be shared with other industries as we go on. But the recovery will also be limited by factory closures. So there are factories that have closed and therefore won't be able to contribute to the recovery. And here we're thinking particularly of the engine plant in Bridgend, just down the road from where this presentation is coming to you from, which closed at the end of September. And of course, the already announced closure of the Honda plant in Swindon next year. So they won't be around to contribute to the recovery as we go through for the UK automotive industry. Now, obviously, if you're going to make stuff, you need to be selling it. So it's worth looking at the recovery in car sales. And this is largely cars. We use the term light vehicles because the Americans have a completely different sense of what's a car and what's a light vehicle. So we use their term, but it is essentially car demand. You can see that sales in China are already back above where they were at the end of 2019. And indeed, Europe, Japan did get back to that level, although it's simply since fallen back a little bit. We don't have the UK on this particular chart, but car sales in the UK are significantly down in 2020. One thing to remember, of course, is that although sales are back to the level they were in Q4 2019, all those chunks below the line of 100 in February, March, April, May in some places, those sales have been lost, or at least partly lost. If you were seeing a complete recovery of all that lost demand, the current sales level would be well above 100, because it's got to catch up that lost demand. So while some of it's been caught up, some of it's been lost completely. And for the manufacturing sector, that's driving this sort of picture. Now, just a word about what this is showing. This is by unit numbers. So this isn't value, this is number of cars and number of engines manufactured in the UK on a 12-month rolling basis. So you can see that car manufacturing peaked early in 2017. Engine output in terms of unit numbers peaked at around 2.8 million units for the year. around the middle of 2018, and since then both of those have been on a somewhat precipitous downward cycle, accelerated in April by the factory closures that are well known. Just to give you a couple of figures, in April 2020, the UK only produced 197 cars, not 197,000, 197.0 cars and 830 engines. So virtually a stop. May was better, but still way below normal levels. So it's going to take some time for the auto industry, manufacturing industry in the UK to recover. And that's illustrated by this chart. Now you've seen similar different versions of this in Jeremy's presentation. Tracking is both the scale of the downturn, so between Q4 2019 and Q2 2020, i.e. the pre-COVID peak and the post-COVID trough. You can see that the United Kingdom is well down, has in fact the largest percentage fall, not far off the level in India and Brazil, but nonetheless slightly larger downturn. And then I've highlighted the UK line here to help you. If we look at the recovery, you'll see that by the first quarter of 2022, the UK is not quite the laggard. We've moved slightly ahead of India, but nonetheless, that's essentially a timing and profile measure, because we don't actually expect UK automotive manufacturing activity to get back to its pre-COVID level probably ever. I mean, it says not before 2050, but for the purposes of this illustration, that's essentially never. And that's a combination, as I said, of factory closures and of the impact of Brexit on the UK manufacturing sector in this particular industry. And remember, that's on the baseline assumption that there is at least some form of free trade agreement between the UK and the EU. Moving on to aerospace, I mean, aerospace really has met its perfect storm in COVID-19. Global air travel has collapsed, and that's probably an understatement. And output activity is going to take a long time to recover in aerospace. Spoiler alert, but it's not quite as bad as the automotive outlook, but it's not pretty. So you can see here that there's been a sharp fall in air travel, particularly in passengers, obviously. You know, we're not allowed to fly anywhere, so we're not. Freight activity had been a little bit weak through 2019. It had been in negative territory, not significantly so, but nonetheless had been in negative territory. And even that has fallen, despite all the stories we read of all these passenger aircraft flying around the world, just loaded with freight and boxes sitting on seats and all that sort of pictures that we've seen. The load factor, I think, is probably less important. I find it hard to believe that the load factor is quite as bad as is quite as good as 60%. I think that must be taking into account freight in the load factor measure. But nonetheless, you can see that the impact that's been on air travel, and orders inevitably are weak. This chart tracks the two major aircraft builders. You can see that while Airbus didn't do too badly in 2019, it wasn't one of its great years, but nonetheless was reasonably year for orders. Boeing's order intake was very low in 2019, and that's largely to do with the problems around the 737 MAX aircraft. The narrow-body single-aisle aircraft like the 737 and the A320 series, they make up the bulk of unit numbers in terms of aircraft orders. Indeed, they make up the bulk of value as well, but there's a slight distortion because they're not quite as expensive as things like 777s and A330s and A350s. And Boeing's orders are even weaker in 2020 than they were in 2019. So it's been a pretty bad year, pretty bad 2 years for Boeing. and we can expect aircraft orders to fall away. In fact, there's a question mark about whether all those orders will be accepted by their customers when they are finally delivered. We see a very different profile as well in terms of the aerospace manufacturing recovery tracker. And you can see here again the spike that I talked about in the UK. So in fact, we went up in the first couple of months of the year. And the downturn in aerospace output hasn't been quite as great in the UK as it has been in the EU and the USA, which are the bottom two lines, at least in February, March, April, May. But it does look as though the UK may take a bit longer to recover. Aerospace output in the UK was still falling in June, much later than the other countries where the recovery was already underway. And you can see that in contrast to the automotive chart that I showed a few slides ago, no countries are back above 100, so none of them are back even close to the pre-COVID level in terms of output. And again, comparing the UK with other major aerospace manufacturing areas around the world, while the UK hasn't seen the largest downturn in the aerospace industry, that prize, if you like, goes to Japan and to China. The UK is the weakest, just ahead of Canada, by the first quarter of 2023. Note a bit later than we had in the automotive chart. And also has the latest point at which it gets back to Q4 2019 levels. In the case of the UK, that's not until 2024, which is not great, but at least it's better than not before 2050 that we saw for aerospace. Machinery and to some extent metal products are very diverse industries, so it's a bit more difficult to get precise and specific charts that illustrate what's going on in those industries. But the new orders for capital goods from the big suppliers like Germany, Japan, less so the USA. Actually, the orders data from the US hasn't shown such a large fall. That's partly because the German and Japanese data on this chart is only for exports, not for total, which it is in the US. But nonetheless, you can see a very sharp fall in new orders for capital goods in Germany and Japan, which are indicative of what's happening in the global market. And the recovery tracker for mechanical engineering, which we normally call the machinery industry. Again, you can see here, again, a different profile, but the UK is now well at the bottom of this line. The UK is the grey line, which is at the bottom of this chart. We're a long way off getting back to 100, something that China has achieved, and perhaps most spectacularly, South Korea has achieved. In fact, you look to the early months of the downturn, South Korea didn't really have much of a downturn from COVID at all, and has done better. And this is largely a product mix story, I think, as much as anything else going on there. So let's come back to the UK and try and turn to our forecasts. You can see here that the various industries, most of them look weaker, particularly machinery and automotive look weaker in 2020 than we had earlier in the year. You can see a relatively strong bounce from the automotive industry, although it's worth pointing out that the 33% fall that we've got for 2020 is followed by a 32% growth in 2021. But remember that doesn't balance out. You're talking about 33% of a much larger number than the growth on which 32% is based. And the growth then in 2022 is very anemic. So it will take a long time. This doesn't contradict the view that automotive activity doesn't get back to its pre-COVID levels. You can see in aerospace there's almost no growth now expected in 2021. So really not much. There's not even a bounce likely in aerospace. A little bit in 2022, but not much. The machinery industry has a bit of a bounce again in 2021. not that significant, particularly if you look at the larger downturn in machinery this year. And again, all the growth rates are pretty anemic for 2022. So really, most of what you're seeing next year is just simply a mathematical recovery. I won't spend a lot of time on this table. We've talked about the risks around the forecasts. They're mainly there as an aide-memoire as we move to the detail of what we're now forecasting for machine tool demand and for cutting tool demand in the UK. We expect for machine tools, we're expecting a fall of, and I will use the word only because in a global context it's relatively not as bad as some countries, but about 24% in 2020, so roughly 1/4. But then a recovery of only about 10 or 11% in 2021, and not much better, tailing off pretty rapidly into 2022 and 2023. The cutting tool market, a similar downturn in 2020, which is not surprising in a way if you think of the factory closures and so on, as well as not investing. Obviously, people weren't cutting any metal, so they didn't need the tooling. So we do see a similar fall in 2020. What's perhaps slightly surprising is that growth isn't stronger in 2021. You would have expected the investment outlook to be weaker than the output outlook, but that doesn't appear to be the case. What is a bit stronger perhaps is the growth going through 2022, and this may be a timing issue in the quarterly pattern which lies behind these annual forecasts. Just to say, I haven't given you the quarterly profiles in this presentation because they're a little bit misleading in the current circumstances. You'll get a very, very large growth rate for 2021 simply because Q2 2020 was very low. So I thought the quarterly profiles were perhaps a bit misleading. This chart brings those percentage changes into showing you the levels, and you can see the significant downturn in machine tool demand and in cutting tool demand in 2020. Interestingly, for machine tools, it doesn't take us back to the financial crisis level that you see in 2010, whereas for cutting tools it does, or not quite, but almost. And that's actually a function of the growth that we've seen over the previous decade, really. But then you can see the recovery going on through to 2023. And the interesting year to focus on, I think, here is 2016, which was sort of a bit of a pause in both sides, if you like, of manufacturing technology, in that we do get back above the 2016 levels, if not in 2021 by 2022. I think I've got a few moments in which to just quickly flick through the global machine tool forecast. I'll do this fairly quickly, but the presentation slides will be available for you to download, and there are some notes on those slides which will give you a bit more information. Inevitably, the global machine tool market is falling significantly this year. The 2019 fall that you see is largely a China story, and which was particularly weak in 2019. The 2020 story is the rest of the world and COVID. And you can see it takes 3 or 4 years for the recovery. And even then, we don't get back to 2018 levels. It takes us that long to get back to even 2017, 2019 levels. Regionally, again, you can see the impact of China on the 2019 figures for Asia, and indeed to some extent 2018. Asia had been the weaker area, but that is largely China. In 2020, it's Europe that sees the largest fall, and then all 3 regions see a mechanical bounce in 2021, and the Europe is simply the strongest in that, mainly because it had the largest fall, as we'll see in a moment. If we just look at the markets, the major markets by regions, I've picked out Germany and Italy here and then lumped the rest of Europe into either Western or Eastern Europe. to be honest, Eastern Europe is largely central rather than Eastern, but anyway. And you've seen the impact on Germany of the automotive industry, and there's an electric vehicle story going on there, as it is in the UK as well, in terms of the market. Domestic orders in Italy are still relatively weak, and their new transition plan around Industry 4.0, essentially a continuation of their tax incentives, will be an important driver of the recovery in Italy if it's to happen. And then the rest of Europe sees a very much a mixture based on their industrial mix and the policy response in the various nations to the COVID-19 crisis. Asia, again, you can see, or you don't really see the fall in the Chinese market in 2019 because we start the chart there, but you see the further fall in China in 2020. In Japan, you see a much stronger fall in 2020, and a more gradual post recovery bounce. Korea, slightly surprisingly, given on the earlier slides, it's probably seen some of the most significant second wave infections in the Asian area, but there is a strong financial stimulus going on there, which will help. And although India has the biggest impact from COVID, so the largest percentage fall in 2020, it also has a reasonably strong recovery, not just for mechanical reasons. In the Americas, there is an assumption of further fiscal boost being approved by the USA, which I guess was partly behind the question we had earlier about the importance of the outcome of the election. So there's perhaps a question mark over recovery in the USA, maybe around timing. The market in Mexico is very weak. Brazil's economic recovery is one of the strongest, much consumer-led. So for machine tools, although the Purchasing Managers Index has been very strong in Brazil, for the machine tool industry, the implications are less so. And just to complete the picture, you can see the difference in terms of output and investment across the regions and the forecast for those, and the risks around the global forecast are essentially the same as those for the macroeconomy and for the UK. There is a working through of a couple of those scenarios, machine tool baseline, but I'll leave you to read about those in the presentations and in the documents, as I think we're almost out of time and there may be a few questions. So I think that's probably where I want to leave it.
Thanks very much, Jeff. Yeah, as Jeff said, I know we said this was going to finish at midday, but I appreciate there's been a lot of information there. So if anyone has got any questions for Jeff or Jeremy or Andy, then as usual, feel free to use the raise hand function, and we've got a bit of time to take some of those.
Also, James, if people want to ask them afterwards, send them in by email. We're happy to deal with those. Either I'll reply or I'll pass it on to Jeremy and Andy if it's more their expertise, and we'll get an answer for you. So if you think of something just as you hang up, don't panic.
I will leave that just for literally 30 seconds to see if my computer's catching up with anyone that wants to ask a question. Otherwise, as we mentioned at the top, these presentations will be available. They'll be on the members area of the website, and a link will go out to those after the event. And again, this recording we will take a look at, and for those of you that want a copy, we'll be able to send that out as well. I'm going to make the assumption there's no questions. If anyone has got one, we've got about 30 seconds while I just quickly wrap up. I just wanted to say a huge thank you to all three of our speakers. I hope this format's worked for attendees. I appreciate it's slightly different to how we would normally do things, but hopefully you've still found it useful. Feedback on these sort of things are always very appreciated, so if you want to drop me an email with any comments, then feel free to do so. And just a quick reminder that as MTA, we are looking at doing another couple of webinars on various topics, so just keep an eye on your inboxes in the Friday brief for information on those. And our AGM this year will be going online and will be held on the 8th of December. Again, further details of that will be coming out shortly. In terms of how to join and how to send votes in ahead. There have been no other questions, so on that basis, I will once again say thank you to all three of the speakers and wish you all a pleasant rest of the day. Many thanks.
Thank you very much.
Thank you. Bye.
Thanks, everybody. Stay safe.
Thank you.
Bye.
Yeah. Bye.
Yeah, thanks, guys. Very good. See you soon.
Thanks.
Thank you.
Bye.
Many thanks, gentlemen. Take care. All the best. Stay strong.